For Canadian investors, the taxation of dividends can often seem like a complex and daunting subject. To have an effective investment strategy, it's essential to understand the different types of dividends and their tax implications. I'll explore the taxation of dividends for Canadian investors in detail. We'll examine the different types of dividends, how they're taxed, and what you can do to minimize your tax liability. Dividends are profits distributed by a corporation to its shareholders as a return on their investment. The most common types of dividends include eligible dividends and non-eligible, or ordinary, dividends. Eligible dividends are those paid by Canadian public corporations and some private corporations, which are subject to a more favorable tax rate. Non-eligible dividends are those paid by small businesses or private corporations not eligible for the enhanced dividend tax credit. Understanding the tax treatment of each type of dividend is crucial for Canadian investors looking to optimize their investment returns. Eligible dividends benefit from the dividend tax credit, DTC, and a gross-up factor, making them an attractive option for investors. The gross-up factor for eligible dividends is 38%, meaning you must increase the dividends received by 38% to determine the taxable amount. This additional amount allows Canadian investors to enjoy a tax credit on their dividends, reducing their overall tax burden. The federal DTC for eligible dividends is currently 15.0198% of the grossed-up amount, with provincial DTC rates varying depending on your location. Let's assume you receive $1,000 in eligible dividends. You'd need to multiply the dividend by 138%, $1,000 * 1.38, to determine the taxable amount, $1,380. You would then apply the federal and provincial tax rates to calculate your taxes payable and subtract your federal and provincial dividend tax credits to determine your net tax liability. Non-eligible dividends do not benefit from the same favorable tax rates as eligible dividends, as they have a lower gross-up factor and a smaller DTC. The gross-up factor for non-eligible dividends is 15%, resulting in a taxable amount that is 115% of the dividends received. The federal DTC for non-eligible dividends is currently 9.0301% of the grossed-up amount, with provincial DTC rates also varying by location. Using the same example as above, if you received $1,000 in non-eligible dividends, you would multiply the dividends by 115%, $1,000 * 1.15, to get the taxable amount, $1,150. Again, you would apply the federal and provincial tax rates to determine the taxes payable and subtract the federal and provincial dividend tax credits to determine your net tax liability. Here are some strategies you can use to minimize your tax liability related to dividend income. Invest in a registered account. Dividends earned in registered accounts such as RRSPs, RRIFs, and TFSAs are tax-sheltered, meaning you won't have to pay taxes on the dividends until you withdraw the funds or, in the case of TFSAs, not at all. Split income. If you have a spouse or common law partner in a lower tax bracket than yours, consider splitting your dividend income to reduce your overall tax liability. Income splitting strategies can include using a spousal RRSP, setting up a joint investment account, or using the pension income splitting rules for certain types of dividend income. Maximize your tax credits. Ensure you are using all available tax credits such as the dividend tax credit, personal tax credits, and others relevant to your financial situation. Seek professional advice. A tax professional can help you optimize your investments to minimize your tax burden, tailor your strategy to your unique financial goals, and ensure you're taking advantage of all tax credits and opportunities available to you. Understanding the tax implications of dividends is a crucial part of maximizing your investment returns as a Canadian investor. By implementing effective tax planning strategies, you can reduce your tax liability, leaving you with more money to reinvest or use as you see fit. Consult with a professional financial advisor to ensure your tax planning is tailored to your unique financial situation and objectives.